Today, let's look at interest rate immunization and how it applies to liability-driven investing. First question, what is interest rate immunization and why do we need it? When a company has a debt to pay for in 3 years, it can buy an interest-bearing bond that also matures in 3 years. When the bond matures, the company receives the principal amount and the coupon payments, which can be used to pay for the debt that also comes due at the same time. The company faces the risk of interest rate fluctuation. More specifically, it faces the cash flow reinvestment risk, which happens when coupon payment is received but can only be reinvested at a lower interest rate. The company also faces the price risk, which happens when interest rate increases and the bond price drops. Notice, however, these two risks tend to cancel each other out over time because the loss on one side is covered by the gain on the other side. The objective of interest rate immunization is to design a bond portfolio so that despite fluctuation in interest rate, the investor is assured to get enough cash from his bond portfolio to cover for liability payment. Question 2. How to immunize a single liability? There are 3 conditions to satisfy to make a bond portfolio immune to interest rate risk. Condition 1. The bond portfolio's initial market value must be equal or greater than the present value of the liability. This condition is self-evident because one must have at least the required amount to pay for one's debt. Condition 2. The asset portfolio's Macaulay duration is equal or close to the liability's due date. This condition is necessary because the portfolio's Macaulay duration is when the cash reinvestment risk and price risk cancel each other out. So, at the Macaulay duration, the asset portfolio is immune from interest rate fluctuation risk. Condition 3. Asset portfolio's convexity should be minimized. Doing so minimizes the portfolio's structural risk and ultimately leads to portfolio interest rate immunization. Structural risk is the risk that twists and non-parallel shifts in yield curve lead to change in cash flow yield. For example, in a barbell portfolio, some assets have shorter durations while other assets have longer durations. So, when the yield curve twists, the losses or gains across the yield curve do not get balanced out and the cash flow yield of the whole portfolio changes. On the contrary, if the portfolio is a bullet with assets duration concentrated at the investment horizon, all the twists along the yield cannot influence the cash flow yield. So, the portfolio with the least convexity has minimized its structural risk. It is important to take all 3 conditions into consideration when choosing which asset portfolio to use. For example, if portfolio A's Macaulay duration is close to the liability's duration but not exactly the same, this does not automatically disqualify portfolio A. We should also compare the convexity between portfolio A and B and choose the portfolio with the lowest convexity. Question 3. How to immunize the interest rate risk of multiple liabilities? When there are multiple liabilities, an asset portfolio needs to satisfy 2 conditions in order to immunize the interest rate risk and provide enough cash for liability payment. Condition 1. Money duration of the asset portfolio matches the money duration of the liabilities. Money duration is the absolute price change given a 1% change in the bond's YTM. It is a function of the Macaulay duration, the cash flow yield, and the value of the assets or liabilities. Using money duration is more suitable than Macaulay duration for multiple liabilities because the liabilities may have different present values and cash flow yields. Condition 2. Asset portfolio's convexity must be greater than the convexity of liabilities. As shown in the function below, convexity is a function of a portfolio's own dispersion. As in the case of a single liability, we want to keep the portfolio convexity as low as possible. But, as a more convex portfolio gains more when interest rate falls and loses less when interest rate increases, we want to make sure that the asset portfolio's convexity is higher than that of the liabilities. When evaluating the duration of multiple liabilities, the more frequently used term is basis point value, also known as BPV. BPV is simply the money duration multiplied by 1 basis point, or 0.0001. For example, if the BPV of an asset portfolio is $200, it means that for each 1 basis point change in the cash flow yield, the market value changes by approximately $200. If there is a gap between the assets and the liabilities, one can purchase or sell some bond futures to close the gap. Basis point value is used in this case to calculate the number of future contracts to buy or sell. Buying a future contract increases the asset portfolio's duration. Strategically speaking, an investment manager may decide to over or under-hedge the liabilities, because if the interest rate is expected to fall, an over-hedged position with more future contracts will gain as the futures increase in price. Hope you enjoyed today's video. See you next time.